Because we're under pressure for time, we'd appreciate it if everybody could settle down, claim their seats, as we'd like to start with our next presentation, which will also be followed by a panel discussion. To our panelists who are also very eagerly awaiting to start in conversation, Thomas, thank you so much. Everyone else, please have a seat and feel free to bring your refreshments. A reminder, though, ladies and gentlemen, that of course we would encourage your feedback, not only on social media platforms, but of course giving us some insight on the app as well. But moving on to a conversation that builds up from the conversations we've had earlier this morning, my next speaker, ladies and gentlemen, will take a look at the changing landscape of property and asset management in Africa. This will be sure to unpack as to how we can get the most out of properties and portfolios across the continent. Gavin Cox, Head of Retail Management and Retail Leasing at Brawl Property Group, Nigeria, will give us some insight into this presentation. This will be followed immediately by a panel discussion. Time provided, we will incorporate a Q&A session so you can interact with the panelists who will also be venturing into the theme of smarter property and asset management for Africa. He'll be joined on stage by Thomas Riley, MD for Growthpoint Investec African Properties, Investec Asset Management under the UK. Greg Pearson, co-founder of Grit and Gateway Delta Mauritius. Guido Giachetti, Executive Chairman of RDC Properties in Botswana. And Dhruv Pundit, CEO of Feda Group in Kenya. Gentlemen, please make your way onto stage, and Gavin Cox will give us a presentation on changing the landscape of property as well as asset management in Africa. Give them a warm welcome, ladies and gentlemen, and feel free to interact with the panel.
The opportunity to speak here today on behalf of Brawl Property Group. I'm fortunate to be based in Lagos, Nigeria. I've been there for 5.5 years, and I've had the benefit of seeing the good times and the bad times. And I've also had the privilege in my previous career, before I joined Brawl, of working in emerging markets and listening to Dr. Martin this morning. Sorry, forgive me, Martin. I was also lucky enough to be involved in emerging markets throughout my career. I started off in Dubai in the heydays, 2000, and I was managing director of a shopping center called Sahara Center. And then also within that family business had the benefit of being involved in the Dubai Sports City. And I also had the benefit of seeing the boom in Dubai, and then I've also experienced the crash in 2006. So that opportunity has also given me an opportunity to understand what we're experiencing in Nigeria. Quite a different market, however, but it gives you some insight. Then post that, I spent 5 years in China in developing a mixed-use development in Beijing, with the Monex Group, with Martin Ragg. I'm sure some of you will know him. And I also had the opportunity there to work in an emerging market and deal with some of the challenges that one faces in the People's Republic of China. And that brings me to my presentation today, and that's looking at Nigeria. And I've also had the benefit of starting in Nigeria in 2013, when it was the heyday. I'd never seen rents like I saw in Nigeria anywhere else in the world, but I had the benefit of being able to work for Brawl at that period, and I've been there from 2013 to date. So I've seen the boom, and of course I've seen the crash, which took place in June 2016, and I've obviously been through all the trials of tribulations of running properties in this very difficult time. So what I'm going to do now is just to give you an overview of the market before we get on to our panel discussion. And the subject is the changing landscape of property and asset management. And I'll start off firstly with just advising you that I'm going to speak purely on Nigeria because that's what I understand. But a lot of the Nigerian dynamics obviously apply to a lot of other African countries, particularly West Africa. So you'll see a lot of similarities to what all the previous presentations alluded to. So the outline today is, as I said, the overview of the Nigerian market, distinguishing asset management from facilities management, which most of you will know. So I don't want to teach you anything, but it'll just give you an idea, just to remind you. And then the challenges facing asset management, and then capitalizing on the opportunities. So what I've done, well, actually not what I did, but what my research department did for me, was to have a look at the general market in Nigeria currently. And if you go on to the next slide, you will note behind me there are 3 bar charts, and I'll speak about that very shortly. But I'd just like to remind you that the Nigerian economy is based on one single commodity, and that is oil. And we had a rude awakening in 2016, mid-year, with the fall of the oil price, which led to a significant decrease in our local currency, which is the Naira. And we saw Naira values increase to the dollar from an average of $200, 200 Naira per $1, right up to 450, which put exceptional pressure on our industry, which is basically retail shopping centers, commercial office, etc., where in principle, if you would imagine, you had a dollarized lease, a denominated lease, and in principle, your lease or your rent had increased by 40 to 50%. So what did that mean for us as BRAL, as property managers? Well, it meant that we saw significant pushback from tenants in the sense of their ability to be able to occupy those spaces. We saw vacancies, and we've seen a significant pushback in the sense of rent collection. But at the same time, we also have had potential tenants that are unable to take up new spaces in new developments, which has made it even more difficult for us to fill those new developments coming on stream. And if you look at the 3 graphs that are, actually you can just go one back, please. You will see the exchange rate and the dynamic that took place in 2016 right through until 2018. Most of you will be familiar, that are familiar with the Nigerian story. The inflation similarly skyrocketed in 2016, however has peaked off and has settled down in July 2017. GDP growth, as you'll see, was very positive in 2015, but was really affected in 2016, as you can see. And then moving on, just a little further, the challenge is that after all of these wonderful things that have happened to us in the market, the Nigerian Central Bank put in exchange controls to try and regulate the fall in the currency, which did assist and has stabilized the currency to 360 to 1, which you'll see on the previous graph has given us a relatively stable currency over the last, after the last 2 years. But that really hasn't trickled down into the wider economy. We haven't seen that affecting our business, that is shopping centers, office, etc. We haven't really seen the net effect of that. And of course, the other problem we have is investors have not injected new capital into the markets, which has been very disappointing. And a lot of the projects that we had in the pipeline have either been put on hold or have been cancelled. So potentially, if one looks at the next slide, you will look at the consumer confidence. One back, please. Consumer confidence, which is in 2016 was really at a real low. And then, as you can see, going forward to 2018 has improved a little, but by no means by any leaps and bounds. And then, of course, the business confidence index, you will also see, both on the construction and on the wholesale and retail trade, has also been significantly affected. What has this done to our business? Well, it's contracted our business by 3.88%, and that was up until quarter 2018, second quarter of 2018. And it's been a very weak and fragile recovery, weak demand, and we're still dealing with all those significant fallouts. And the net effect, unfortunately, is that rents continue to decline and markets remain oversupplied with both retail and office space. And if you look up on the screen, you will see real estate services, and there's a bar chart indicating the trend. And then, of course, the second one is the percentage change in prime asking rents, and that's also indicative of the trend which I've just described. And similarly, on core market stock, you will also see that there's a significant oversupply of both retail stock and office prime stock. However, it's not all a negative story because we're managing it. We are managing it with the necessary concessions, fit-out allowances, and various other concessions to actually get our premises filled. We don't necessarily have the kinds of yields that we originally bargained upon, but we're still managing the process going forward. So there is still a positive story. Then, of course, the next slide, I don't want to teach you guys anything because most of you will know this, understanding asset management. And there's really two key differences between asset managers and facilities managers. I don't have to go into the detail. It's on the slide. If you want to look at that later, you're welcome to. But there is a significant difference. But those two parties work together to make our assets work. Then moving on to the challenges for us in Nigeria. And our recession has caused a contraction in the demand, reduced values of our investments, and that's in both sectors, both retail and office. The other important criteria that I need to share with you as both retailers, investors, etc., is the Nigerian legal system doesn't support us as shopping center managers, as investors, etc., purely because it's based on residential law, which was last updated in the year of our Lord 1954. And unfortunately, the benefit goes to the tenant versus that of the landlord. So we end up doing less of, well, let's hand them over, guys. We don't do that anymore. Actually, we sit down with the tenant and we negotiate the best way out of these challenges. Because if we go to court, it doesn't work for us. There's uncertainty in tax policies and regulations, which makes planning very difficult. And there are some of our landlords sitting in the audience here today, and they will tell you that there are taxes always appearing that they never could have planned for before, which really means that, it's very difficult to do your planning going forward. However, this is not synonymous to Nigeria. This particular phenomenon is very indicative in most African countries. So the reality is that asset managers spend more time on preventing further reduction in their asset values as opposed to what they should be doing, and that's maximizing returns. So most of my time is spent with my asset manager looking at how I can prevent further reduction in the value instead of actually looking at maximizing the returns. However, on the positive side, what are the opportunities? Well, it's realignment, and I'm sure you've heard this over and over again, realignment of the real estate offering. There is a case in effect of brownfield redevelopment projects in Nigeria, and I'm sure in other African countries. A lot of buildings standing derelict that could be redeveloped if it's in the right area, and the cost is particularly effective, and the rents you can get in return are positive. There's definitely a case in brownfield redevelopments. And then, of course, the discussions we've had on a regular basis with all our landlords is smaller retail concepts. And in the past, we were building shopping centers of 18 to 25,000 square meters, even up to 30,000 square meters. But now we're saying 8,000 to 12,000 square meters is probably the better option. Why? Because our tenant pools are very shallow, and they're all the same. And the reality is, if we're going to fill these centers and get the kind of rents we're looking for, we're going to have to make these centers smaller. However, once again, as you will all know, the smaller the center gets, the more difficult it is to get a good return. So, smaller retail concepts. The market and demographic fundamentals in Nigeria cannot be disputed. It's still a wonderful market. The last figure we have is 155 million people in Nigeria. And in Lagos alone, we have 22 million people and growing. So there's an opportunity that still exists. So in principle, the African story is still alive, and we need to continue pursuing it. And I've got to be honest, that's why I'm still in Nigeria. I haven't given up on it. And I'm still talking the African story, and I'm still very positive that the retail, office, and other markets that we manage as BRAL in Nigeria are seeing a recovery going forward. And on that, in my last slide, I've just summarized what I've just spoken about. And very briefly, we spoke about pre-2015. We spoke about the pre-FX market crash, which I'm sure you'll all know about. 2016, the economy crashed as a whole. And in 2017, we saw the beginning of a recovery. However, I'm still waiting for that to happen in its entirety. And in 2018, us as asset managers are spending more time, as I mentioned earlier on, is actually trying to prevent the reduction in value of our assets more than looking at maximizing the return. So that's the principal story that I wanted to share with you. And based on that, we're going to go to the panel, and we are going to share some questions with each other and just explore some of these issues that I've just alluded to. And obviously, once again, this is going to then be affected in different regions, in different parts of Africa, even as far as the UK. Okay, so thank you very much. So let me move on to the panel, and we can start with that. Hopefully I'm running on time. Where's my lovely lady? Is she around? No. Welcome, guys. I know most of you, yes. Thank you for taking the time to join us today. The first question I have is a general question, and that's to give an overview of asset management and the landscape in your respective countries and regions. So where would you like to start? Would you like to start with yourself?
Can do. Thank you. From Nairobi, family-owned business. We're in retail, hospitality, resi, and commercial. In fact, within a 7-kilometer radius of that building. Well done, whoever put up that backdrop. That's my office just there.
Is that your office over there?
Yeah,
okay.
Just on from the top. And why am I pointing to that building? Because it's you're absolutely right. We've had to play defensive in the last year or two, coming more of our, as you heard from the macro speakers, it's not really the petroleum question or resource curse, it's really our election cycle. Went through a tough year, liquidity is tight at the moment, et cetera, and a lot of parallels. So we are very much on the defensive for asset management in terms of trying to preserve asset. But I think that if I had to give one message coming forward, I think the smarter developers, or at least are looking at agility. The road is very clear, right? If you've been to Nairobi, you know our roads, a lot of potholes. So how fast do you want to drive is the question, and what car are you driving? Are you driving a four-wheel drive and you're building resilience? Then you can drive that much faster. Or are you going to be dodging those potholes and navigating what's coming there? And so it's a question of agility. I'll just give you one example of what's happening and some of the thinking we're doing is, yes, compromising on rents and fit outs and all the rest of it. But what are we actively doing to underpin our commercial property? I'm trying to get a Mug and Bean in there. Simply because it's an international brand, it says something about your property. And it'll tip that decision for that person at a market rent to come to your building straight away.
Give some flavor to your asset.
Absolutely. You've got to go to that micro level to really make a small difference. I don't know if that's answering your question, giving you a bit of micro flavor.
I think that does give flavor.
Very, very similar type of challenges. But I think the second message is we have to play offensive now. And the real offense is that a lot of people, all the corporates or all the people there have a budget. How much of that budget is really going to you in rent, and how much is going on service charge and building consumption? And we are actively investing on making sure, and this is the time to double down on our investment, in fact, to make sure that we can minimize that service charge. So bring down the utility costs, bring down the cost of garbage and servicing, going for a sustainable building, so EDGE certification post, which is great. We're going for in our Resi building, we're going for the first LEED Gold certified building, not for the Halo status. It's nowhere in our marketing documents. It's there because I know I can run that building as an all-suite hotel way below anybody else's cost. I've got no AC in the building. And you know, I could give you endless number of examples.
I think that answers the question from Nairobi or from Kenya. I think potentially my view is much the same, is that if we are looking to create value for tenants look at the total cost of occupation. And that means the cost of their rent, their energy cost, and their service charge. And that's really the number that tenants look at. So if you're able to reduce the energy consumption of your building and you're able to return that to the tenant, then that is an opportunity for you to guarantee that your rental will be paid, hopefully on time. So thanks for that. I think that's very valuable. Thomas.
Thanks, Gavin. Morning, everyone. I think, managing property costs and the tenant costs is obviously an integral part of managing a property business at the end of the day. But I think if you have to segregate the direct sort of property management or facilities management side of things, you know, a lot of that is encapsulated in the management of that side of the business. If one looks more at asset management within the sector, in my mind, you know, it's a far broader and a multifaceted sector or specialization of the industry. And you know, a lot of that, you know, if I look at the business that we're setting up now, and I think, you know, in terms of the downward cycle that you've mentioned, I think we've been fortunate enough, and it clearly wasn't by design, but we capital raised through the downward cycle, and we chose to come back now at the right time to buy. So crystal ball wasn't in play there. That broke a long time ago, but I think we're fortuitous in that sense. And I think what that leads on to really is you know, enabling us to structure the business overall from an asset management perspective in terms of looking at the assets, the right type of assets, where they're located, and then the backing structure in terms of debt, in terms of taxation. So, you know, trying to structure the overall platform to deliver on the whole objective of asset management, which at the end of the day is trying to enhance and improve the returns to your shareholders. Right. So that's the end game. So if one looks at that. Okay. Just in terms of from a debt perspective, and we see this so often in a number of the transactions that we're busy looking at, and you know that people are calling us on, is really, you know, you often have developers who come through, find a piece of grass, push up a top structure, and that debt package is structured really to aid the developer, much higher LTV, or it's a much higher borrowing with regards to the cost of the assets. And it's not really, or what's not kept in mind is that ultimately that asset's going to be vended, and you're going to have let's call it an aggregator of assets such as ourselves or one of the others coming through, and that debt package is not suited to really facilitate the returns to their type of shareholders. So I think the debt structuring, you know, needs some work, and often when we come in and acquire an asset, you know, we've got a lot of work to start speaking to the banks, restructure those debt packages, et cetera, and I think a lot of that work could be done, you know, ahead of the time. The tax side of things is a completely different ballgame. I mean, that is there's really a hands-on and a changing environment all the time. And linked to that, the regulatory side as well is critical in terms of making sure that you can manage your tax line. Akin to that is the currency, and you've had a lot of issues in Nigeria specifically with regards to exchange controls, etc. Making sure that your cash at the end of the day finds its home in terms of where you can ultimately distribute your earnings. So those are sort of key issues. Aside from that, scale. I think if you're talking specifically retail, it's not going to help, for us to go and I get your point about smaller assets and so on, but I think, it's Decathlon. I think Malcolm mentioned this morning that Decathlon's come into Junction, I think, in Accra, which is great. And, they're trading out of their boots, but, they're not going to come into these centers to just have one outlet. So from a landlord maximizing value in terms of asset management, you need to have a number of outlets to try and attract these bigger brands. So I think, all of these things linked together into what is really quite a complex, asset management activity at the end of the day.
Is there then a case, in fact, to have a longer-term funding arrangement? Traditionally in Nigeria, we've been very familiar with the 7-year in and out with most of our developers. Is there a case, in fact, to looking at a longer period of time in the sense of the funding?
Yeah, look, I think, if one looks at the 7-year period, I mean, there was essentially a 7-year and 1-day period in terms of your shareholder loans coming into Nigeria, and because of that, you could extract, funds free of withholding tax on interest, as an example. So that was a sort of a necessary driver in terms of just, making sure you got the most out of the country sense. In terms of longer-term debt, sure. I mean, any owner of real estate as a long-term owner is going to favor a long-term debt package. There's no doubt about that. What is critical, though, is that package needs to be structured appropriately to suit, to be fit for purpose. So it doesn't help having, coming in as a developer, developing an asset, knowing that you're going to try to vend that asset after, let's say, a 3-year period or thereabouts, and up front putting in a 7-year loan package, which we've seen kind of maybe not 7 years, but it's been longer term packages, and the issue is then that we come in and have to try and sort that out because it doesn't suit ourselves. The level of gearing is too high. We need to declare dividends or distributions to our investors, and you find that most of your distribution is eaten up in interest. So that doesn't help us. So there's a blend. I think a long-term holder or perpetual capital vehicle such as ourselves would favor long-term debt, but the terms are critical. That has to be structured correctly.
Thanks, Thomas. Great. Guido?
Just as a background, as a group, we've been involved in assets, real assets, from Nigeria to Madagascar, Mozambique, Namibia, and Botswana over the last few decades. We listed in Botswana in 1992 a property fund, and from there we started investing, essentially in Botswana, and now from there diversified all around. So I'm not going to teach anybody what asset management means or property management. We have a lot to learn. But I guess compared to some of the players here, we are those that work in Africa. and I guess in that respect, we've had to become nimble and try to adapt to the different jurisdiction and analyze a little bit what is possible and what is not possible, what are the risks. And typically what you've heard of Nigeria with the devaluations and the issues of dollar-denominated assets, rentals, it is a concern. It has been a concern in Madagascar. It is a concern now in Mozambique, and it is a concern in Nigeria. And at the end of the day, it's a cycle, and you need to look at the long-term viability. So I guess going to promise US dollar returns is very difficult. We would be in a difficult situation if we had to give out dollar-denominated returns. we have the other risk that you have in this kind of little jurisdiction. And in a certain way, although you have 190 million inhabitants in Nigeria, it's the same issue, is the small market, because your purchasing power is very limited. So if I take Botswana as an example, there's an oversupply of assets. And we started as an asset, as a first listed vehicle, and now there are 6 of them, and we're all fighting for the local. So the only advantage we have in a certain way is we enter in sectors where we are the first, we have the advantage of being the first ones on the market. So we were the first ones really to diversify in hospitality at the point, to create a lifestyle center for Botswana, and now we're doing a retirement offering. So those are so we are not sector specific, and that allows us to so-called take advantage of the market. In other jurisdictions, I must say, we are entering and trying to find an edge to foreign currency through sectors. So for example, we would enter in hospitality where you're denominating your sales, your income is related to dollars, because in the national parks, the customers of our customers pay in dollars, so they can afford better rentals. So I guess the asset management becomes a lot wider. It's not purely looking at one asset, one type of asset. It's really trying to understand the politics, the economy of the country, and the influence of the policies of the country in our sector. So you take an example of Botswana again, where government, just to incentivize investors to come into the country, becomes a competitor to your sector. So and a good example is they built a huge innovation hub for investors to come and work in the innovation hub, and they give tax breaks to all the IT companies. The next thing, all the tenants that are in IT, that in your portfolio, they all go away because they have a tax break the other side, and they're no more in your properties. So those are things that are completely spurious to the normal market. So I think it becomes a lot more complicated than just one sector and a large market.
Thank you, Guido. And I think the symptomologies are very similar to most African countries of what you've just defined. So thank you for that. Greg, your experience?
I think if you look at asset management and where it's going to date, South Africa is probably the anomaly on the rest of the continent, where all the other emerging markets and emerging countries that we're working in, we're finding asset management has got its own roles and responsibilities in the different sectors that you're working in. If you look at retail, for instance, the amount of management and time that it takes trying to educate your end users coming into the countries is a lot more than what you would generally do in a country like South Africa or Morocco, where you've got a deeper market. So wherever you don't have those deep markets, I think the level of effort that goes into that, and the sharing of information that we need to do across the different developers, property owners, and consultants, I think plays a very important role. What we've seen as well is, as you've established yourselves in the different jurisdictions, that level of sophistication grows quite quickly. For instance, if you look at a country like Mozambique, you look at the general conditions of the buildings there, and the lack of spend that happened over a period of time during what Mozambique has gone through as a macro. I think educating the people that are involved in the different companies and understanding what needs to go in to the maintenance and management of those assets, I think it does improve very quickly, but it's coming off a very, very low base. There's not very many buildings in these countries that sit in a global level A rating. And as you've got more global or blue chip companies coming into the various countries, I think that level has to increase quite quickly. And the only way that we're going to be able to do that is by sharing information. And I think between yourselves and the likes of JLL and the other, the normal property guys around there, the amount of information share is very important going forward. I think on top of that, the debt packages that Thomas alluded to a little bit earlier is another big play. In, again, a more sophisticated market, the discussions that you have with your lenders are a lot more formalized and a lot more easier because it's a known. Where on the balance of the continent, there's a lot of unknowns that you have to work through. So your debt tenor is a big thing. 3 years and 5 years is viewed as midterm lens, whereas if you look at a European or US market, it's looked at it short. To get the 5, the 7, and the 10 years in Africa at the moment is very difficult. And on the asset management, the amount of effort that goes into that is very difficult. On top of that, if you've got certain lenders that have had bad experiences in countries, their credit committees withdraw out of those countries very quickly. So your refinancing packages become even more difficult as well. So unfortunately or fortunately, you have to look at being multi-banked across the continent. And also the REIT type structures that need to distribute income, need those bullet debt packages, and we're finding that the local banks are not sophisticated or not quite there yet that they understand how to do that. So the amount of effort that goes in to manage a property is not just looking at the property. There's a whole lot of others, different things that you need to look at, which you wouldn't necessarily look at in a formal market.
Thanks, Greg. And I think that symptomology that has been just defined by Greg is very similar to all the emerging markets I've been involved in. It's a process where there's a growth curve which we all have to go through, and that was my experience in Dubai and in China, where tenants ultimately and loan packages all had to be slowly managed in accordance with what the market was actually dictating. So thank you for that. What I'd like to do now is to move on to the specific questions. And the first question we have is for Thomas. And the question is about what are some of the key differences between the UK, effectively Europe, and Africa in regards the asset management overall. So I can read that again for you if you like. What are some of the key differences between the UK, effectively Europe, and Africa in regards to asset management?
Well, I mean, it's simplistically the key difference, without a shadow of a doubt, is, I mean, you've got debt and you've got all these other things. You have a Thanks. You have an established REIT market at the end of the day, So in terms of, and you have it here in this country as well, but first and foremost, and particularly if one's looking at a business that's set up to aggregate real estate assets to provide income at the end of the day to their shareholder base, an efficient REIT market, a market where essentially your taxation policies across Europe are known, are clear, and are easy to be followed is a massive difference. I think we're busy chatting to a potential or a current holder of assets, and there's basically a bus that you can drive through the range of what their potential capital gains exposure is on a particular asset. There's, their accountants are putting forward a number here. There's their view of what the number should be there. There's no clear line of sight, And I think, so taxation, REIT policies, etc., is a clear difference. And I know there's a lot of work that's been done. I mean, we submitted a paper. I know Grit's been involved to some degree as well in Ghana. So there's some work that's being done there. There are a couple of other countries across the continent, but they're limited, So I think that is one of the key things. The other thing, obviously, from an asset management point of view, I mean, I mentioned the debt. I mean, that is, the numerous providers. There's extreme depth in terms of that. You also, from let's call it from an asset management point of view, the other key thing, aside from managing, the debt side of the balance sheet, is the income, right? So I think if we look at particularly countries that have recently experienced some hardship, I mean, Nigeria is without doubt there. I mean, Zambia's started to wobble a bit of late. There have been a few countries that from a macro point of view have had tough times. It's just shown that one needs to, from a tenancy composition point of view, you need to have sustainability of income, right? And you need tenants that can withstand some sort of a decline in the market. And what that invariably leads to is a change in composition from having in a retail center your traditional moms and pops taking up, a fair slug of your mall, where you can effectively outperform and drive return, to rather maybe taking in slightly larger tenants, stronger balance sheets. Maybe it's slightly less rental, but that rental is going to be there tomorrow. So it drives sustainability of that asset and of distributions ultimately. So that's and that choice of tenant is something that you have to a far greater degree in Europe. You don't have it as much in this country. So that comes back to my earlier comment on scale, where if we're going to bring in Decathlons and some of the other big European brands that we see into Africa, they're not going to come in for one store, two stores, or three. You need that scale, and I think we're getting there. Where I think if you look at what we're doing, what Grit are doing, essentially is to aggregate assets. And at some point in time, there's enough critical mass to bring in those European tenants into these markets.
And then we just have time for one more question, and I'm going to pose it to Greg right at the end there again. Greg, sorry, forgive me. And I'll just read it out very clearly so you don't misunderstand me. What are the challenges and implications of managing cross-border portfolios given the different market jurisdictions and regulations from your side?
I think we could talk about that all day. I wish it was as easy as the American politicians made it out to be, where we've got some politicians quoting Africa as a country, or the president calling it a shithole. But in effect, we've got 54 African countries, or if you operate in Morocco, you're not allowed to view Western Sahara as a country, so 53 African countries. You've got over 2,000 languages, and you've got cultural differences across every single one of these countries. So for us, what we had to do is we had to take a look and say, how do we operate in these countries effectively and actually get proper traction in these countries? And to do that, you need team on the ground, and you need local people on the ground. So we took the decision to grow those the companies in country indigenously. So in Mozambique we've got Mozambicans, in Morocco we've got Moroccans, and we found that there's a lot of barriers that that we can break by having that. And when we need to come into the various countries to have those meetings, it makes it a lot easier, because a lot of the ground has been set already, and a lot of that work, the heavy slog work, has been done. And it's also viewed that we're not there as expats to try and pillage as much as possible and leave the country, but rather to have a sustainable business. And we also see that sustainability in that the more that we can grow and maybe put the ethos of our company into those different countries, the more sophisticated we found, and the more opportunity that comes out of that as well. I mean, what we've done is we've set up different MDs and CFOs in the various jurisdictions. We've partnered with local developers in the various jurisdictions, and with that, we found that the barriers to entry have been a lot easier. I think the big thing as well is to try and get that information back to a point, back to our HQ, and then pass that information back through to the different jurisdictions. Going back onto what I mentioned earlier with regards to the consultants and the relationships that we have, that interaction between the Brols and the JLLs of the world that are out there, with their different jurisdictions and offices as well, sharing that information, because there's such a lack of information in these various jurisdictions, I think is very important to educate the market. The other thing is, with the recent London listing that we've just gone through, is it's actually quite startling to see how little the outside world knows about Africa. And I think the more, the likes of the bigger guys that are starting to invest more and more across the continent can share that information and broaden that to new investors in the UK and the US, the better it's going to be for all of us.
Greg, and then just my last question on that. Is there a case, in fact, then to outsource to the likes of Brol and various other management companies in the sense of what you just advised, specialists in various different zones?
Absolutely. I think in the different geographies where those guys have spent a lot of time. I know, for instance, Brol in Ghana have been there for a very long time. They've got a very big team. That knowledge and information, doesn't come easy. So for that, there is definitely a big role to play in that asset management and even down to facilities management. But what we're finding is with getting your international tenants coming into the country, they still want some kind of relationship with the landowner and the developer at the end of the day. And again, that's why I say it's more of a partnership and a lot more interactive in these emerging markets where we all have to play in the same pool and we all have to work together to make sure that we can increase the base. If we bring in 2 or 3 new tenants into a country, it's great because the other opportunities, the likes of Thomas and the other guys that are looking for more tenants, it's not just going to be one developer with one tenant. Those guys need mass. They need 6 or 7 different opportunities to go into.
100%. Thank you for that, Greg. And just one last comment from my colleague on the side.
I'm going to be a bit controversial here. We talk about the cycle, and the cycle will change, and we've bottomed out and all the rest of it. This time, I promise you it's going to be different. All right? I don't think the decathlons will come in that mass or the smaller retail centers. We're all looking at this point about optionality, flexibility of space. Because let's be honest, these guys are coming in, they're looking like the leases like hotel leases because they just don't have that budget visibility going forward to sign a 7-year lease. We've done one with Epson right away with Brol. It's a 3-year license. Forget the laws of Kenya. I'm just hoping that they've spent enough of their fit out so they will carry on afterwards. And let's be clear, it's going to happen on everything else. The retailer, frankly, online's going to kill it. That white goods showroom is going to be a third of the size that Garden City opened with or Two Rivers opened with in future. I promise you it's going to happen that way. So that's, just keep it in mind, optionality and flexibility. Thank you.
Thank you, everybody, for your participation. Much appreciated. Thank you very much.
A round of applause, no doubt, for a wonderful panel discussion. And of course, I think just as we were getting into the groove of it, unfortunately, we've had to cut it short, ladies and gentlemen. But a big thank you once more to Gavin for leading that conversation, and of course, the different and varying views that we certainly received from our panelists. Now, what's also quite critical for developers and investors like yourself to bear in mind is, of course, you need to understand the environment that you'll be operating in, much like the leaders that we've had on the various panels reflecting on earlier today. But what's critical to that is that you need enhanced transparency and access to data. Now, this is the latest report, ladies and gentlemen, of the JLL report with regard to transparency, taking a look at real estate transparency from an African perspective. It is available in your delegate bag, so please do feel free to go through it and read through some of the insight. However, if you'd like a sneak peek and teaser into what you can expect in that conversation, we'd like to warmly welcome on stage our next speaker who'll give us some insight into the theme of the JLL Real Estate Transparency Index for 2018, Data, Disclosure and Disruption, the Africa chapter revealed. Please warmly welcome on stage Mr. Jeremy Kelly for his 20-minute presentation, ladies and gentlemen, on the dynamics of transparency.
Good afternoon, ladies and gentlemen. It's great to be here in Johannesburg today. I've got to learn to drive first, so let me see if this works. Yes. I'm head of the global research team at JLL, and one of my responsibilities is our Global Real Estate Transparency Index. So hopefully today I will give you a little bit of a flavor of what our Transparency Index entails and the implications for the African market. So if I can kick off, really over the past 2 decades, JLL and LaSalle have played a leading role in the pursuit of greater transparency and higher ethical standards across the globe. Market transparency is really about trust. It's about laying the foundations to ensure that investors and corporate occupiers can make decisions with confidence. And it enables, importantly, national and city governments to function effectively, providing, crucially, long-term benefits for society and for the environment. And so as we launch our index today, our Sub-Saharan African Index, our industry is probably under greater scrutiny than ever before. New technology, prop tech, is promising a huge leap in transparency going forward. And so as expectations rise, the need for an objective benchmark as provided by our Transparency Index has become even more important than ever before. And so through 10 editions of our Transparency Index, we've created what is today a widely used and highly valued benchmark of assessing transparency. And at a global scale, we cover 100 countries, 158 cities, and 186 separate metrics that define the transparency equation. Now, our extension of the index into sub-Saharan Africa effectively began in around about 2012 in response to the increasing demands from our clients for insights on what was the rise of the lions or the gazelles that effectively the world's most rapidly evolving real estate market. And so today, our index covers 15 countries in this region across South, East, and West Africa, in addition to the 5 markets in North Africa, which I'm not going to cover today. Now, the index, just very quickly, provides... I'm going backwards. There you go. Just very quickly, the index provides a comprehensive comparison of 6 key elements of transparency. So the availability of performance benchmarks, the amount of data availability on demand and supply and price, corporate governance, the availability or the existence rather of regulation and laws and the enforcement thereof, the transaction process and sustainability. But our index is having to continually evolve in response to the new pressures and the new issues that keep washing our shores, that are testing our industry as demands grow for ever more granular information to inform investor and corporate market decision making. So, as transparency is thrust into the spotlight, why is it deserving of so much attention across this region? Well, crucially, as I mentioned in the introduction, real estate transparency allows investors and corporate occupiers to operate and make decisions with confidence. For investors, a transparent market enables risk management and drives strategic choices. For corporate occupiers, a transparent market boosts efficiency and it offers greater real estate options and flexibility. But more importantly, I think, is that real estate transparency, the relevance of real estate transparency goes well beyond our industry. Governments are increasingly recognizing the role that a transparent real estate market plays in economic management, in boosting FDI, in creating business efficiencies, enhancing living standards, and supporting and retaining and safeguarding the environment. For individuals, transparency means that they can enjoy higher levels of security of property ownership, they can work and live in safe houses and buildings, and they can reliably have high levels of professional services. And a compelling argument for high transparency comes in it would have come in the form of this chart, which is supposedly showing the relationship between national transparency levels and real estate investment volumes. And typically there will be the names of cities and countries on this chart. South Africa at one end, Senegal and Mozambique at the other end. And they're in fact creating a virtuous circle, a virtuous feedback loop as investors push for higher standards, which in turn encourages higher levels of real estate investment, which drives higher transparency. So it's no surprise really that governments are paying much greater attention to the issue of real estate transparency. Now let's see if this next chart shows the names of the countries. I'm afraid it doesn't. I should have checked them first. But the point I'm making here is that real estate transparency enables governments to function more effectively. Transparency is an absolute imperative for successful long-term urban planning, for the management of economic growth, and for investment in high-quality urban infrastructure and housing. And that is even more acute here in the sub-Saharan African region as the world's most rapidly urbanizing continent with the world's fastest growing cities. So let me just quickly take you through what the Transparency Index is telling us about this region. And here's the league table of real estate transparency for sub-Saharan Africa, together with the tiers in which they occupy. Unsurprisingly, it tells us that there is a huge disparity. The devil is in the detail. A lot of heterogeneity here. So we've got South Africa at the one end, Senegal at the other. As Martin Davies highlighted earlier, he called it Africa Light. Certainly the Southern African region dominates the top positions. So we have South Africa, the only transparent country in this region, with Botswana and Mauritius coming in second and third place. Kenya fourth and Zambia rounding off the top five, although Zambia has struggled in the recent survey to maintain its position. Then we have the West African largest markets of Ghana and Nigeria, which are making progress, as I'll come on to show, but have kept their positions in what we call low transparency. But maybe less encouragingly is that most commercial real estate markets, including some of the largest, such as Angola, Ethiopia, and Tanzania, continue to be entrenched in the opaque category. Now, our latest survey does reveal that on aggregate, the sub-Saharan Africa real estate market is making progress. And out of the 15 markets that we cover, 10 have seen some level of advancement over the last 2 years. But it is a mixed picture, and following solid gains in previous surveys, progress appears to be slowing and is still too slow in an environment where investors and businesses, as well as society at large, are demanding ever higher levels of transparency. But encouragingly, most of the major markets within our Transparency Index have shown advancement since 2012 and have moved to a higher transparency tier. And Kenya and Nigeria have led improvements driven by the growing presence of global corporations and international real estate firms that are boosting data availability. They have also seen improvements in the ease of transaction processes, valuation standards, as well as government initiatives towards more open data and digitization. For the region as a whole, here I show the changes in transparency across the 6 main sub-indices that make up the index. And so where have been the improvements? Well, I identify 4 areas. First, accessibility and quality of real estate data, as international service providers deepen their involvement across the region and technology is aiding the collection of data. Secondly, valuation standards are rising with the greater use of third-party providers and increased frequency of valuations. Thirdly, international service providers are also contributing to higher standards of transaction processes, such as bidding processes, such as due diligence and tenant service charges. And also, government data initiatives are pushing forward digitization of data and services, and e-governance portals, for example, for land tax payments. But most of the initiatives have really come from the private sector, but we can start to pinpoint several new initiatives that are boosting transparency in individual countries that are government-led. As I mentioned, Kenya is one of the top improvers, with government initiatives such as the digitization of the land registry and progress on their e-citizen service on property transfers and land tax payments contributing to their improvement. Nigeria has introduced new regulations in the Real Estate Regulation and Development Bill and more open publication of land transfer statistics. Rwanda, which was flagged earlier by Martin Davies, has introduced new building codes and urban planning systems and has strengthened quality controls, and certainly one to watch. And whilst new legislation supporting the development of the REIT market is also starting to move into Ghana and Uganda, but I'll come on back to that in a moment. So how do we expect transparency in the region to evolve going forward? What lessons can we learn from the rest of the globe? Of course, the world's most transparent countries provide the gold standard in terms of regulation, benchmarks and practices for which the sub-Saharan Africa region can emulate and copy, whether it's the UK in terms of performance benchmarks, whether it's the Netherlands in terms of its vibrant prop tech industry, the US with its deep REIT structure with high corporate governance standards, or France, which leads the world in terms of sustainability initiatives and green building initiatives. Each provides a pointer for global best practice. But I think it's amongst the world's top improvers that offer the greatest insights, I believe, on the steps needed to enhance transparency levels. And so, for example, Dubai is one of the world's top improvers and has been for several surveys now. And it's here that a dedicated Dubai Real Estate Regulatory Authority has been mandated to advance transparency and has introduced a host of initiatives to improve market transparency, land registry information, and has introduced various online applications to bring into tow broker information and leases and contracts. Now, looking forward at the four areas that I think will shape real estate transparency in sub-Saharan Africa is the rise of PropTech. Secondly is about the regulatory enforcement. Thirdly, it's about deepening liquidity. And fourthly is the expansion of sustainability regulations and practices. And I'll just touch on each of those. First, PropTech. Across the globe, we know that property is amid a technological revolution. And PropTech is potentially, could be the strongest future driver of real estate transparency across the globe. And unsurprisingly, the adoption of PropTech is highest amongst the highly transparent markets such as the US, the Netherlands, Canada, Australia. But PropTech is also moving the needle further down the transparency ranking in places like Dubai or China, for example, where there's a vibrant PropTech industry. And new technologies could well enable sub-Saharan Africa to leapfrog the traditional process of transparency improvements. And as we note, PropTech covers all aspects of property services, whether it's about smart buildings or online listings or data aggregators. And governments across the region are taking steps to digitize data collection and publication, as well as creating online e-governance portals to improve efficiency and visibility. And we're also aware of several governments, including Kenya, Ghana, Rwanda, that are working with the private sector to set up working groups to investigate this whole area of blockchain. But whilst PropTech offers a lot of exciting potential, it's certainly not a panacea. And in fact, regulatory enforcement, far less sexy than PropTech, but is far more crucial in the building blocks of market transparency. And further progress in the ability to put new and existing regulations into practice, particularly relating to building standards, land use planning, and financial regulation, will be essential for sub-Saharan Africa to make meaningful improvements in transparency levels. And then thirdly, we have liquidity. As we all know, and we've heard from the previous panel discussions, institutional capital currently plays still a limited role in most sub-Saharan African markets. An increased market participation by investors and the development, crucially, of a listed sector are key factors across the globe that enhance publicly available information, increase visibility of current market trends, and improve in investment performance. And as Tom Mundy, my colleague, mentioned earlier about the REIT market, and Thomas Riley just now in terms of the development of the REIT market, there is some encouraging moves in terms of REIT legislation, most recently in Ghana and Uganda, but take-up is crucially slow. and has not really caught on yet. So a key area to watch. And then finally, we've got sustainability. The transparency of sustainability regulations, benchmarks, and practices remains at a very early stage across this region. And only South Africa scores outside of the opaque category on this measure. And while green building certification systems have now been established in several African countries, there has been limited progress and take-up, and issues such as energy efficient standards and carbon reporting frameworks are way behind the rest of the globe. So, let me just quickly wrap up with my 5 key takeaways. And in fact, there will be a 6th one. I mean, our latest index reveals that the region is making progress, but it needs to pick up the pace, not only to catch up with the rest of the other regions globally, but to meet the rising expectations of investors, businesses, and communities for much higher standards. It's the West and East Africa hubs of Nigeria and Kenya that are leading the charge, supporting by greater data availability, improved valuation standards, and government digitization initiatives. PropTech and digitization offer an opportunity for the region to leapfrog the traditional routes to transparency, but it's not a panacea. Increasing market participation by institutional investors and the development of a listed sector will be crucial to boosting transparency. And most pressingly, regulatory enforcement will be a key to making meaningful improvements in transparency. And the region needs to catch up on sustainability regulations and green building certification and energy conservation measures. But if there's one message that I would like to give, it's that the relevance of the real estate transparency issue goes way beyond our industry. It is absolutely fundamental for the efficient functioning of our cities. And that's particularly important for sub-Saharan Africa as the world's fastest urbanizing economy, to enable city governments to plan for the long term, to introduce new technologies, absolutely crucial for the long-term success of Africa's cities. So with that, I don't know if we've got time for any questions. I think I'm exactly on 20 minutes, but I believe now we're going to open it up to a panel discussion.
There will be a panel discussion indeed that will follow through, and if there are any questions, we'll take them just after the panel discussion.
Okay,
but thank you so much for the wonderful presentation, and of course, being bang on time. Mr. Jeremy Kelly, ladies and gentlemen, a big thank you to Jeremy for giving us some insight into the report. Now, naturally, of course, we need to extrapolate a lot of that information, and looking at many of those markets and regions where many of you actually have investments in, they sit in the opaque category. But what does that mean on the ground and for your investments, and of course at the coalface of a lot of your investments? We'll have a panel discussion now, which will certainly follow through with any key questions that you might have. So if you do have any questions, please do take down notes, and of course this will be addressed by the moderator of the panel. Now, this theme follows through the Transparency and Data Reliability Roundtable, and looking at building the African real estate investment case through improved transparency, valuations, and data. Ladies and gentlemen, please warmly welcome on stage the moderator of this particular panel discussion. He'll also be followed by his panelists who will be participating in this conversation, moderated by Stan Garin, who's the head of Africa Analytics Project, Urban Real Estate Research Unit, followed by panelists Dolapo Omidere, founder of Estate Intel in Nigeria, Julian Garcia, who's the MD of Sagacity Research in Kenya, Aileen Andrew, client consultant for MSCI, and Mark Fairweather, managing director for Africa at MRI Software. Please warmly welcome them on stage and participate with them in a Q&A session with the panelists.
Good afternoon, everyone. Good afternoon to the panel. I'm just going to take a few seconds just to sort of introduce the way we're going to handle this. I'm not going to introduce you. I mean, we've already introduced you. But as you speak, I think probably a few words on who you are and what you do might just help. I want to say thank you to JLL and particularly to Mr. Kelly for that presentation, and in actual fact for really setting an agenda which we will, to a very large extent, cover again and again in this discussion. I'm sure that our brief is simply to look at transparency and how to foster it, and data provision in a real estate, in the real estate environment in Africa. Quite very specific. It's about transparency and it's about data. Mr. Kelly told us about transparency, and the data we're talking about is simply the fundamental data, which is stuff like returns, market size, yields, rents, transactions, etc. JLL lists the categories of transparency they look at. So we essentially are looking at the first two, which are performance measurement and market fundamentals. And that is as far as our discussion goes. We're going to treat this as a conversation. So essentially, let's kick off then with my first question or discussion point, and I'm just going to put it to the panel and then just call on you to comment. I think we all probably agree that availability and reliability of data is poor in sub-Saharan Africa, indeed all of Africa. You may disagree with that if you wish. So the first question then is, what are the reasons for this? Then the second part of the discussion is, why is there so little progress? Year after year we come to events like this and we complain, or we speak about it, but very little changes. So please comment on that. And then also what is being done quite specifically in your organization, in your region, in your industry, thinking about it. If you can't directly influence transparency, how do you believe it can be done? So I think I must start with Julian. Julian is able to give us a perspective of Kenya, which is one of the countries that improved in the JLL. Didn't move into another tier this year, but certainly is showing along the improvement trend. Thanks.
Thank you very much. So maybe as a disclaimer, Sagacity Research is actually collecting data across the African continent. So we are part of trying to improve the availability of data for our clients across the continent. There are several reasons why so little data is available on the continent. One of them, obviously, is some of the government are not making that information available, and we saw in the previous presentation that things are getting better. And as you mentioned rightly, Kenya is also trying to do things in order to make data available. I also think that there is a lack of scale in some of these countries to make data available, and together with the lack of scale is probably a lack of providers being able to collect the data, probably some data from the government, analyze it, and then being able to redistribute it in a way or in another. If you take, for example, consumption-related data, understanding how much money do consumers make, how do they spend their money, what's happening is very often the data you get from government is outdated and might not be detailed enough. But so collecting that data for private players is obviously costly, and because of the lack of scale of some of these markets, it becomes a bit complex to collect it across all of the different markets and to update it on a regular basis. So that could be one of the reasons, the lack of scale. But yet, things are getting better. We see also more and more providers of data, such as us, positioning themselves on the market to be able to support investors, developers in providing the data. Beyond that, I think some of the players in African markets are very traditional in the way they operate, and so are very reluctant to share data, and are preferred to keep secret or to keep quiet on some of the data. And so same thing, we operating in this market in Kenya, but also in the 20 markets we cover across the continent, we are trying to convince players to share some of the data, and it takes time. It takes time to show that you are credible, that you will not do anything with the data, that you will keep the data confidential. And so I think we still need a bit more time. We need more players, we need more involvement from local government, and also a bit more time to be able to have access to good data across the continent.
Thanks, Julian. Mark, you want to add to that?
Sure, thanks very much. I think it's interesting to look at the availability of data. I think, we're certainly more on the technology side and the system side. And I think as we sit here and speak about it, we are providing systems and solutions that store all of this information in 20 African countries. And I think as PropTech's sort of providers, we need to look at the ways that we can actually disrupt the way that things have been done in the past. The time it takes to get access to this information, to then manually take it, collate it into information that is used and leveraged by the market is taking far too long. By the time it comes out, it's not necessarily timely anymore. And I think that's where our role as technologies providers comes in, that we're going to look to actually change that. And so, what are we doing about it? I think we're investing in partnerships with research units such as Ureru to try and streamline and change the model that's been working in the past, so that we can make the information instantaneously available for those people who want to share the information, make it very easy and painless for them to do that, and then make the market data more relevant.
Thanks, Mark. Delapo, did you want to add to that?
I definitely agree with the first point you made on the government being the first point of call when it comes to making data available. That's how it is in most of the other structured markets across the world. But I think within Africa, you find that there actually is a lot of information that's scattered, but it's very unstructured. The very hard part in getting through that is being able to figure out or identify what is accurate and what is inaccurate. The second part of, I think, the data space in Africa is, one, trying to move past the sharing discussion. I think part of what we do in these events every year is talk about, everybody needs to share their data. But I think the reason why that doesn't go as far is because we're not really providing the incentive for the investors or the advisors or the leasing agents to share that information. And I think once we can create an ecosystem where information is shared, and every part of the value chain can see benefit, then we'll probably get slightly closer to getting to a more transparent market, and with data flowing a lot easier within the circles.
Absolutely. Thank you. I think I'm gonna move in, and then you can say something after that if you wish, Eileen. I just wanted to just reflect on what Bronwyn in the earlier panel said about 54 countries that are, or 53 and a half countries that are very different. We speak about Africa as though it's Africa. And we know it's different, and it's at different levels in different areas, and there are different dynamics that govern it. However, just by listening to the people speaking this morning in the various presentations, you can see how much information there is, how much good information there is, and how much analysis is in fact being done, although it may not be quite what we're looking for in terms of transparency and the sharing of data. I believe, my personal opinion is that it's shockingly poor. The JLL index gives you evidence of that. Half of the SSA countries are opaque. I don't think any country improved into the next tier from 2014 till the 2016 report. And reliability goes along with that. Generally, there isn't a stamp of independence or a stamp of objectivity on this data, not anywhere, except for IPD in South Africa. MSCI, who now run the IPD indexes, are arguably the leader of that type of information. And I think it almost gives you an automatic tick in the JLL box. But and of course the data is impeccable, the source is good, it's totally trustworthy, and so on. So what are the reasons? Because after all, this is the age of prop tech, of big data, and then also, in addition to the fact that we're on a tech, moving into more of a tech environment, we also have very large property companies, broking, management, advisory type companies, not scattered, there are a couple of very big ones which are represented in just about every corner in Africa, who all have data, who all use data, yet the data that could define the transparency of African markets is somehow evasive, and it's an absolute mystery to anyone outside of Africa, anyone in Europe sitting down and trying to examine Africa, despite the amount of sophistication that there is. So what's holding back the democratization of real estate data? I think there are a number of reasons, and one can rattle them off: political, macroeconomic, lack of commitment to good research, reluctance to share information, corruption, etc. But I think that it boils down to probably 3 points that you can somehow combine. The first is that is this crazy culture of secrecy that somehow people are fixated on. Somehow hang on to the data, and then I've got some advantage over you. Secondly, the lack of political and commercial will to collaborate and make info available. This is the age of collaboration as well, by the way. And then thirdly, entities that are actually vested or have a vested interest in opacity. They don't want reality to come out. So with all that, not only is it physically a different thing to actually collect, a difficult thing to collect this information, but it is in fact a stonewalling process that we're facing. So there's only one way, to my mind, that we could break this, and that is to disrupt it. And I think that's what Mark was referring to. We need to storm the gates. We need to really set the data free. The data is there. It's just not coming through, and we have to. We'll have that advantage, which was spoken of earlier, that a lot of Africa technology we can actually leapfrog in the sense that it hasn't been there before. So there's a bit of a start there. MRI, who Mark runs, he's the MD for MRI in Africa, has been assimilating and working with the information of many, many property funds in over 20 African countries for 20 years, something like that. And that data we are going to look at trying to work with. Mark and I spoke about a year ago, and we've been working since on trying to see how we can do that. There will exist in the near future a MDA or MRI stroke URERU package that will provide analysis and research and data to clients with their permission, and therefore intel that would stretch over a continent. It has to be a PropTech solution. It's a big data application, there's no question about that. But I think what is significant here is you can't, if we were going to collect data directly from owners and managers and so on, we would have done it by now. We've tried and tried and tried. So if we can take that data and transmit it across the internet, we have a much better chance. Okay, I think that's all I want to say on that. But what I can say is you don't need to if this goes well, you don't ever need to wait 5 months before you can get your reports anymore, because this will be real-time stuff, it's live. You don't have to rely on surveys, you don't have to type figures into spreadsheets, etc. Okay, who's next? Eileen, you want to add to that?
Just talking to your point on transparency, I think the reason that MSCI or IPD formerly have been fundamental in that transparency index, and we've seen it globally where they started in the UK, was because what we're able to do is create that index that is consistent across the world. So whether you're reading a total return number in South Africa and you're comparing that to any of the European markets or the Asian markets that we're covering recently, investors can understand that. And it's that understandability when investors are deploying their capital into various markets that give that transparency. And I think if Africa wants to start playing in that sort of space and asking for investors to deploy capital into Africa so that they can start building, they absolutely need the reliable data source and the index that comes out of an IPD or an MSCI type index.
Okay. What about Africa, Eileen? Generally, I mean, you're in South Africa and all of that. What about Africa?
So looking across Africa, I think one of the problems that we've looked at previously is the scalability, very much to Julian's point. There aren't, very often we need enough data to be able to create that index or those benchmark analytics. We also pull the data from the landlords themselves, from the property owners. And our regulations are incredibly rigorous around what data we collect, when we collect the data, what are true valuations. They need to be made by RICS-approved external valuations on a 3-year rolling basis. So there's a lot of rules and regulations around our data collection and processes and validations. So I think for us that's been quite a bit of a barrier. But as the likes of some of our South African clients move north, the likes of the Growth Point and so on, we'll definitely follow them.
Thank you. Thanks, Eileen. And wouldn't it be wonderful if it just got there, the data just arrived?
Make my day,
and it was 100% accurate, which MRI has been doing for the last 20 years. Yeah? Okay, sorry, on to the next one. Next question or discussion point is a little bit different. This whole thing of transparency, everyone talks about transparency the whole time, but yet many people, many developers, many investors, many entrepreneurs do very well in Africa without much fundamental information, only experience, market knowledge, and their own feasibilities and targets. Some just have a lot of grit and courage, if you pardon the pun. But what would you say to a successful developer who comes to you and says that secrecy is their competitive edge? Their data is theirs, and that's what they trading on. They say, I know what yield I want, I know what return I want. I won't share my information with anyone, there's no value in it for me. Who wants to have a go at that? Delapo.
Hello? Yeah, so the first instance, actually, if I come across a developer that says that, is I probably won't blame him. I think Africa is a very tough market to work in. And once a developer takes the time and invests in getting some information to guide their investment decision process, somebody else coming to them to say, okay, just give me this information, share it for greater market transparency, they're going to think, are you mad? So I think what we need to communicate is the benefit that transparency offers. That investor, once he has done that research in the first instance, he's going to need to update it in the next 1 or 2 years. As time progresses, capital is deploying faster into Africa, so it's becoming a lot more competitive. If you're looking at a market like Nigeria, somebody who had done a report in 2014 would quickly find that everything he thought he had found out in 2014 is completely different in 2016. So the market is becoming a lot more competitive. The things are moving a lot faster. So the individual efforts that developers are making on their own is not going to get us to a greater place in, or to get everybody to greater returns at the end of the day. what we find out, or what we see across Africa now, is that all the data that we have is held in silos. Lots of property firms, agents, etc. have excellent data, but it's all in silos, and that actually provides very different representations of the market. You find in Lagos, one developer or one property provider says there's 500,000 square meters of grade A office space. Another leading provider can say it's 700,000. And if we are not able to get basic market metrics like that right, especially when developers are working on their own, we're not collectively going to be able to execute and create better investments. So I think, like I said earlier, I won't blame them in the first instance, but what we need to try and do is communicate what the greater advantage is to the market. And that's sort of what we're working on at Estate Intel, where we're trying to essentially create the Bloomberg terminal for African real estate. So that, I mean, each market participant has their data and has information, and that's their competitive edge. But we're trying to provide a central market data source for the basic market metrics, like your stock, your occupancy rates, your cap rates, your yields, for all the markets across Africa where there are important things happening.
I think just to add to that, what Delapo mentioned earlier is the incentive to get the data. And if the data is so hard to get, and I've had to work so hard to get this, of course I'm going to be protective about it. I mean, I've invested all of my time, energy, and now I've got some sort of an advantage out of it. But if we can kind of shift the market and make it a lot easier, show the benefit of that, incentivize people to be sharing their data, it kind of takes that away and lets you work on other areas which could be more value adding to your business than trying to find the data.
I think one just needs to clarify, you know, we talk about sharing data. It's never sharing someone else's proprietary data. Never is. It's just contributing to a greater database, which would be anonymous and would be unavailable to anyone except the broader public. So your data will never go anywhere else. So I think that those kind of fears are really unfounded.
Yeah.
Because ultimately, it's a rising tide lifts all boats, and I think that's what we'd like to achieve in this. There's another thing that I also was thinking about, and I put it down here, is that do we really need? I mean, if the Chinese are investing to the extent they are, and they're taking this Silk Road right through Europe, the Middle East, and ending up in Africa, and there are these big projects being done all over the place, and there are smart cities and all of that. Do we really need all this transparency, all this private market activity? Is that a silly question? Julian?
I don't know if I will answer the question directly, but I think, you know, the usage of data from Chinese investors will be very different from the usage of a South African investor, right? And for two reasons. First, the Asian or the Chinese investors very often will invest in infrastructure or maybe in real estate, but on very specific assets. And I'm not sure, at least from my standpoint on being locally, in the market, we have never been approached by Chinese investors because they probably rely on either other data or no data at all because they have different ways of doing business and deciding whether to invest or not. So I don't see, the influx of Chinese investment in East Africa, for instance, as a promoter of transparency and more data available on the market, at least, right? I think it's more European, American, South African investors who will develop across these markets, who will promote and try to develop publicly available data on this.
I agree. I think just to add there, and we're going to open up to the floor to just ask you just to comment or ask questions of the panel, if you wish. But what I was going to say, I think there's no substitute for a proper, functioning property market, real estate, transparency, real estate investment, and an open market. And I think that's got to be where Africa's got to be. That's the direction in which Africa should be facing. my
But
view.
just also, sorry, coming back to one point on, we're speaking about 54 markets, so the complexity also to be able to collect good data, aggregate good data, is working in 54 African countries, one, which is huge, and second, in each country, working to the point we discussed earlier with small companies. So if you have to gather the data, and all of us mentioned this, you need to gather it to a multiple number of small companies locally in each one of the 54 markets, which is, adds a very strong layer of complexity.
Absolutely. Okay. I think at this point, you've had enough time to think about your question or your comment. Is there anyone on the floor who would like to ask us anything, basically, from anyone on the panel? Come on, there's got to be at least one question. Okay, while you think of that, let's move on. Just to one further, I think we've got, how long have we got? 5 minutes, okay. I was going to talk about South Africa, but I think I'm not, except just to reflect that, does it really make sense? And it's maybe you've got to think about it, the way South Africa is at the moment, the difficulties we're having in real estate, in the economy, in the political arena, that we're so far ahead in terms of transparency. We are at the moment seeing research diminishing, and I say this sadly, that it's not to say there isn't good research being done, and it's being done by lots of people, but there is no quantum increase in research in South Africa at the moment. And when I say research, I mean data analysis, all of that. And I think that is I think JLL has been kind to us. And I just hope that we can maintain the position that, or South Africa can maintain the position it's had in the past. But that's a comment more than anything. Does anyone want to say anything about that? Do you feel anything about that? No? Okay. Right. Now I'm going to hand over to the experts, because we're talking just quickly about land regulation. Okay. Dolapo, Julian, Eileen, right. Are we making progress with land regulation, broadly speaking, over different geographies in different countries? Can you expand on this? How does this fit in when you talk about ALP producing huge logistics parks, big retail investments, smart cities? And then on the other hand, there is this enormous need for low-cost, affordable housing across the continent that doesn't seem to have a very clear solution. So asking yourself, how does that fit in? Is there a balance? Is there any balance in that whatsoever, or are we just leaning in the wrong direction? And I think land has quite a lot to do with that.
Okay, so let me just confirm I got the question. You're asking about the land regulatory environment and its impact on what exactly?
Yes.
Yes. Its impact on what?
Yes. Look, the emphasis is on land regulation, and I'm saying that the need and the use of land seems to be very upmarket. It seems to be very much not a social compact. It is more of a technological growth thing, which is fine. But what about the social part? And is the land regulation dealing with that? Are land regulations dealing with that?
Okay. I'll touch on Nigeria, which is my home market. But I think with land availability, pricing, those are really important issues, or one of the biggest challenges people face when you're trying to develop in Nigeria. What we've seen over the past few years is that the government is making new strides, as JLL pointed in their report, to make the land transaction process a lot faster, to ease the titling process. But in Lagos specifically, you're seeing the government being more active in trying to reduce the housing deficit. There are a lot of private developers that are working, but because of high land prices, it makes it very difficult for them to execute low-cost housing at scale. But what you're seeing recently in the past past two governorships, so to speak, the government is now donating land, or they're looking around doing that to enable private developers then execute lower cost housing. This might not be in the heart of the city, but it would be further down where infrastructure is planned. And I think when you look at it like that, that's probably one of the ways, especially when you think about social
There is
housing.
progress, and I think that's
Maybe just allow me to comment. Interestingly, in
absolutely.
Kenya, the situation is very similar to what you described in Nigeria, where things are getting much better in terms of making land registration public and easier, etc. Yet, there is a very big issue, which is the cost of the land in order to develop affordable housing. Everybody speaks about affordable housing, yet no modern developer manages to develop actual low-income housing in Nairobi, at least, just because the land is so expensive. Then when you add on top of the land, the different regulations, how high can you build, etc., plus the actual cost of constructions, it's very, what you end up having in terms of housing, it's not a low-income housing. It becomes a middle, high-income housing, and which is a big issue.
Yes. I know, listening to some of the prices of so-called low-cost housing in South Africa, it's incredible. I mean, it just doesn't ring true. Anyone with that question, that elusive question? There's someone right at the back on the right, on the left, looking from your side.
Hi, Alistair Anderson from Business Day. I just wanted to ask you, is there any country outside of South Africa that actually has proper data? Any country outside of SA that has proper, credible data in Africa at the moment that investors would take seriously right now?
I'm probably going to deflect that to Eileen, but I would say no. I think there's nothing really. There is information. There are researchers. There are economists working on information. There's government information that comes out late, but it's not adequate. And so I don't think it's really there. But perhaps Eileen can give us a bit more on that.
So probably the short answer to that question is no. There isn't an MSCI index in any of the other African countries. Probably your best or next best reliable source of information is your research type of information, and not so much the index, the hard index information, because we're just not there yet.
But wait for the Urban Real Estate Research Unit and MRI Index, which is coming. Okay, are we just about done?
Dolap, will you just have a brief response,
Sorry,
then we can
quick
take one more question from the floor? Go
Okay,
ahead.
yes. I definitely agree. The robustness of data in Africa is not sufficient, but there is data available, credible data that investors can use to make business decisions. It's definitely not at the complex level that you would use in an MSCI index, but I would definitely say that there is information out there in at least the key markets like Nigeria, Ghana, increasingly now Cote d'Ivoire, Kenya, etc., that you can actually use to make a valid investment decision.
Absolutely, and I think the technologies improvements, prop tech and so on, will facilitate more of that. Anyone from the floor again? There's one next to the aisle.
Can anyone discuss what blockchain technology is doing for transparency in the markets? If you have any experience or knowledge of what's going on.
You want to go for that, Mark?
Blockchain technology.
Yeah, I can provide a comment on that. I think, the real estate industry is one that's typically lagged fairly slowly compared to, as an example, the fintech industry in terms of adoption of new technologies and so on. I think there's absolutely a case for down the line, blockchain. There's a number of use cases that would make sense in the real estate industry, but I think we have to walk before we start running, and I think we need to put in some of the basic building blocks in terms of open data and connectivity before we get there. So that would be my take on it.
Yeah, unfortunately, as someone also said this morning, was if you don't have an answer in Africa, you invent one. And really, I think that's true to a large extent. And I would just say, if there's a takeaway from this, and maybe we should just end by just having a brief takeaway. I would say the main takeaway is that Delapo has been saying again, and there is information. It is there. It's just a case of getting to it. And I think that for me is the major takeaway here. Mark, takeaway?
Yeah, I think we've got all the building blocks. We just need to connect them all together. That's and be willing to do so.
Delapo, takeaway?
Yeah, I think I've said it all, but just to add, I think we are open and we would love to work with anybody that wants to help improve transparency. Definitely it's not going to be a one-sided thing. I think we need, and I think that's why we keep having this discussion. Once we can understand and create value on both sides of the spectrum, then we'll be able to really
Right.
change things for the good.
I think we're getting somewhere, bit by bit. Julian?
No, I would just say that some of us here are actually working hard to making data available, more transparency, etc. We just need probably a bit some time in order to maybe to reach the level that some of the investors would be expecting.
Absolutely. Eileen, what about training? Just reflect on that as well. Okay.
I think the thing that we need that we provide as MSCI is that consistent standardization of measuring property. And we actually make publicly available both our data standards and our methodology documents so that investors, funds, owners, developers can use that information within their own systems to understand how to calculate a total return. So in terms of the training part, that's certainly there, but it's also very much there in a document that you can go and read and internalize into your own processes, which hopefully gives the very first step on the run to understanding data.
And often it's nice to stand in front of a group of people and tell them about it. You do
We
that
could do
kind of-
that too, Stan.
Okay. All right. I think that's done. Thank you to the panel. Thank you, everyone, for listening.
Indeed. Ladies and gentlemen, please a round of applause for both Stan, Eileen, Julian, Mark, as well as Dolapo as they leave the stage after the panel discussion. Thank you so much for your contribution. And I think, as they mentioned, many takeaways for us to certainly resolve from this conversation. But the key element here is certainly collaboration, collaborative efforts to make sure that that data is secure, the data is shared, and of course, everybody is empowered to make critical investment decisions. Now, in a moment, we will be breaking for lunch, but I'm going to keep you here just for a little bit longer, ladies and gentlemen, as we move to an exciting part of our program. Now, many of you are well aware of the API Awards, ladies and gentlemen, where we look to honor and, of course, give recognition to those who have been bold enough to step north of South Africa's borders and across east and west and look at developing some quality real estate developments across the continent, ladies and gentlemen. Now, these awards have been running for a second year in a row, and we've also enhanced and increased the level of finalists in various divisions to at least 12 this year. Now, as we do move forward, 14 categories. Just to give you an update as to how the assessment process does take place, we do review projects which were completed between 2016 up to the 14th of August this year. And this is a peer-recognized awards program, the first and only of its type on the African continent. Whilst we also do this, we take a look at niche categories across the board and truly believe that there's a fair and transparent approach to the independent jury and scorecard system of acknowledging those who are going to be awarded this afternoon. Now, to those of you who are aware of yourselves as being finalists, we do kindly request that you move slightly closer to the front of the house. This is just to enable the logistics with regard to how you will receive your awards. A brief walkthrough, you will be joined on stage by Kafia Rutsen, who is the managing director of the API Awards. You'll make your way to the center of the stage where all the bright lights will be shining on you, and that's for your moment and photo opportunity for our cameraman to get a wonderful picture of you. Your colleagues are also more than welcome to also take pictures of you. Selfies might be welcome, and of course pouting, well, that we leave to you to make an independent decision on. But we please ask that you work with us with regard to the logistics, because there are at least 12 categories to get through. And given the limitations on time, we'd like to make sure that we do wrap up at least before 1 o'clock. So to all the finalists, we do understand that some of the finalists are not present in order to accept the awards. However, there will be a representative in the room, and alternative means will also be provided to make sure that all winners in the various departments and jurisdictions do receive their awards. I'm glad that many of you have also paid attention to the screen, because this is our awards jury for this year. Needless to say that fair representation from across the continent of leaders within the property space, and of course advisors as well with regard to the various sectors that we take a look at. This is the exciting part of the program, ladies and gentlemen, so I'm hoping your sugar levels will kick in just a little bit higher to make sure that we do celebrate with some of our colleagues in the room. But we start off by taking a look at the first category, but before we do that, perhaps I should welcome on stage the Managing Director of API Events, Mr. Kafir Russen, who is a familiar face to many of you here in the room. Ladies and gentlemen, as we do start off with the first category for the best retail development, we'll start off with the finalists as listed on screen: the Bayer Mall in Mozambique, Cosmos of Cote d'Ivoire, and Village Walk in Zimbabwe. Should I let you linger longer, or should I just keep the pace going? Linger longer? Linger longer? I literally did. Ladies and gentlemen, the winner for the category the Best Retail Development in the API Awards for 2018 is the Bayer Mall of Mozambique. May a representative please make their way up to the stage to receive their award. Congratulations. Is there anyone present? Thank you so much, sir. Congratulations, this is the winner of the Best Retail Development for 2018 in the API Property Awards. Congratulations once more. We move on to the next category, ladies and gentlemen, and this one is for the Best Office Development. The Best Office Development, the finalists for 2018 as listed on screen: The Wings in Nigeria, Eco Bank in Ghana, and One Africa Place in Kenya. The winner, ladies and gentlemen, for the Best Office Development in the API Awards for 2018, Eco Bank Ghana. May a representative please come up on stage quite speedily, so. Congratulations. That's the winner, ladies and gentlemen, EcoBank Ghana for the Best Office Development. Moving on to the Best Hotel Development, certainly as we've heard this morning, a rise in interest in that particular division. Finalists on screen for 2018, Gem Suites in Kenya, Park Inn in Kenya, and the Radisson Blu in Rwanda. The winner for the Best Hotel Development in the 2018 API Awards, Radisson Blu and Convention Center in Rwanda. May a representative please come up on stage. Interest there, no doubt, given the finalists, majority of them coming through from the east of the continent. On to the next category. This one is for the housing development. No finalists here. Will move straight to the category winner, given that this again was calculated based on the merits and the scorecard assessed by the jury. And the award, ladies and gentlemen, in the category for the best housing development goes to Victoria Crest Homes of Nigeria. Could a representative please make their way through? Victoria Crest Homes. Okay, seems like nobody's making their way up. What we will do, though, is ensure that a representative will be able to receive the award. Any Nigerians in the house? At least an accolade coming through to the west of the continent. On to the next category. This one, again, does have finalists, ladies and gentlemen. This is for the best architectural development. The finalists include EcoBank Ghana, Radisson Blu Rwanda, and Park Inn in Kenya. The winner for the best architectural development, the Radisson Blu Hotel and Convention Center in Rwanda. Good thing you're wearing flats, madam. Congratulations. Congratulations once more to the best architectural development coming through from the Radisson Hotel in Rwanda. We move on to the next category, ladies and gentlemen. This time, the best green building development. The finalists include ALP North in Kenya, Strathmore Law School in Kenya, and EcoBank Ghana. The winner for the best green building development for 2018 is Strathmore University Law School from Kenya. May a representative please make their way up on stage? We've just been alerted that they don't have a representative. However, we'll be sure to make sure that they get their award. Moving on to the next category, ladies and gentlemen, for the best alternative asset development. Finalists on screen, KBC in Rwanda, Enko Benga School in Mozambique, and Raymond House in Nigeria. The winner for the category The Best Asset Development for 2018, KBC Rwanda. Go ahead. Congratulations. If I'm not mistaken, you're the gentleman who raised your hand up when Martin Davies asked earlier about the notes in Rwanda. Many of you might be taking a peep in his wallet just to see if those notes are real potentially, right? Ladies and gentlemen, we move on to the next category. This time for the best high-end residential development in the API Awards for 2018. The finalists include Prime Villas in Zambia, Arkenstone in Zimbabwe, and Pentagon Valley in Kenya. The winner for the best high-end residential development for 2018, Prime Villas, Zambia. Congratulations. A round of applause for them. Just when we thought there wasn't anyone available to collect the award, thank you so much for coming up on stage, sir. Representing Prime Villas in Zambia. I like that. He says he's Zambian, so he's decided to represent his fellow countrymen in picking up the award. Is that not sportsmanship right there? Thank you very much. We will be sure to get it to the representatives of Prime Villas nonetheless, but appreciate your representation of Zambia. Moving on to the next category, ladies and gentlemen, the best logistics or industrial development in the 2018 awards. 2 finalists in this particular category. As you can tell, Wrigley Gum Factory, as well as ALP North in Kenya. The winner for the best logistics or industrial development for 2018, ALP North Distribution Center in Kenya. Should I ask if you're Kenyan or if you're representing ALP? Congratulations, that's the best industrial as well as logistics development center. Now, this is a new category, the one that we move on to, ladies and gentlemen, for the API Awards. And of course, we know all about ensuring that there is a sense of transformation and some change from a gender parity point of view, not only from a Pan-African point of view, but of course when it comes to business across the globe. Now these 3 ladies are leaders in their own right, and of course just a drop in the ocean when it comes to representation of female leadership in the property space. But our next category is the best woman in real estate. 3 finalists that we have here. Finalists are Raki Kantaria from Mauritius, Bronwyn Corbett representing Mauritius, and Funke Okubadeko from Nigeria. The winner, ladies and gentlemen, for the Best Woman in Real Estate for the 2018 API Awards, Bronwyn Corbett, Chief Executive Officer of Grit Real Estate Income Group. Please may a representative or Bronwyn herself make her way on stage. Congratulations. For a minute, I nearly reverted back to the old titles of Atlas Mara, Delta Africa. But Grit is the one that we'll stick to. Congratulations to Bronwyn. Ladies and gentlemen, and a new category again for this year, the finalists for this particular category are the best mixed-use development. 2 finalists in this particular category, 2 Rivers in Kenya and Novare Central in Nigeria. The winner for the best mixed-use development in the 2018 API Awards goes to 2 Rivers Mall in Kenya. Congratulations. That applause can last a little bit longer as she makes her way up on stage. Thank you so much. Congratulations once more. Thank you so much, and a hearty congratulations to all the finalists as well as the award winners for the 2018 Africa Property Investments Award, ladies and gentlemen. No doubt in its second year, but of course this is part of the program that we look to extend over the years and expand on the variety of categories which will certainly develop given the themes and the trends that were discussed earlier today and that will continue to build on, such as PropTech and a variety of others. With that said, though, we will be breaking for lunch very briefly, but I want to remind you that we will be breaking into 3 different streams after lunch. There will be a finance stream, there will be a structure theme, a funding forum, there'll also be a sector forum that focuses on specific sectors and industries, as well as a Mauritius forum. What we strongly encourage you to do, ladies and gentlemen, is to engage and participate in the themes and conversations regarding the forums that you have a personal interest towards. There'll be a variety of speakers and representatives addressing the various matters there, and of course, given that it will be a more intimate setting, you're more than welcome to really engage with the speakers and pick their brains on some of the insight that they share. Given that we will be splitting out into 3 breakaway rooms, this means that we will not be returning to this main plenary as it stands. We need to turn the room around. As such, we strongly encourage you to please take all of your personal information, personal belongings, as well as the room would have been changed and restructured to accommodate the follow-up forums that we'll be hosting. We look forward to seeing you back here at 2:30 sharp as we continue with the various forums and conversations that we have. Enjoy lunch in the exhibition center. We'll see you at 2:30 within the various forums and different rooms that they'll be taking place in. Thank you so much.